Welcome to the College Investor Audio Show, where we talk about the biggest issues impacting millennial money, from student loan debt to side hustles to building wealth. We will show you how to get out of debt so that you can build real wealth for the future.
Here's a question we've been asked quite a bit, enough to make a podcast out of it. What is the Depositors Insurance Fund? That is today's College Investor Audio Show. Thank you for being a part of things and welcome aboard. In the early 1930s, a run on banks left some people who deposited money in local banks without access to their money. The supposed safety of depositing with a bank left many without access to their life savings. To prevent such a run from happening again, the Bank Act of 1933 established the Federal Deposit Insurance Corporation, FDIC, which protects deposits up to $250,000 in checking, savings, or money market accounts. The Depositors Insurance Fund is one of the first precursors to the FDIC. It was established in 1932 to protect depositors in Massachusetts in the event of a bank run. DIF is a type of deposit insurance that protects balances above $250,000. Understanding the DIF can be valuable if you're facing a liquidity event such as the sale of a home, the sale of a business, or a large cash windfall that would push your savings above $250,000. Here's what you need to know about it. What is the Depositors Insurance Fund? Well, the DIF is a Massachusetts-based company that provides deposit insurance on bank accounts with more than $250,000 in them. All banks that are chartered in Massachusetts must be members of the DIF. The DIF protects savers in the event that a bank fails. If the bank where you hold your deposits, aka your cash, fails, deposit insurance will make you whole. DIF insures a few hundred banks in Massachusetts. Here's the thing. Many of the banks it insures allow out-of-state individuals to set up a deposit account. Having a DIF-insured account can be very useful if you're the type of person who regularly has a lot of cash on hand. Isn't my bank FDIC insured? The Depositors Insurance Fund and FDIC insurance work together to protect savers' money. While the FDIC insures all bank deposits up to $250,000, the DIF insures balances above $250,000. In the U.S., all legitimate banks are FDIC insured. By contrast, only a few banks can boast that they are protected by the DIF. If you hold your money at a U.S. bank, the FDIC insures up to $250,000 in money market, checking, or savings account. That means, even in the event of a bank meltdown, theft, or fraud, you would be able to regain access to every penny in your accounts, up to $250,000. Since the dramatic majority of individuals and even businesses have less than $250,000 in cash assets, FDIC insurance is sufficient for most people. Even people with 6 to 12-month emergency funds and a house payment fund are unlikely to have more than $250,000 in cash. Plus, there are provisions in the FDIC Insurance Act that allow individuals to have insurance at multiple banks, as long as the banks are unique and the total balance in the account is less than $250,000. If you do your banking at a credit union, you are not FDIC insured, but your credit union will almost certainly have an equivalent insurance called the National Credit Union Share Insurance Fund, which is administered by the National Credit Union Association, NCUA. The DIF is an insurance product that is offered above and beyond FDIC and NCUA insurance. If you're someone with a ton of cash, first of all, good for you. The DIF insurance program could be very useful to you too. So, you might ask the question, do people really have more than $250,000 in cash? If you're trying to figure out how the Depositors Insurance Fund fits into your financial plan, you might realize it doesn't. Most people don't have $250,000 in cash that they are worried about insuring. Usually finding a high-yield savings account with low fees is really more important than finding an account that is DIF insured. However, might be a few times in life when you will be flush with cash and you might want to think carefully about where the money goes. Here's an example. If you sell a paid-off house depending on where you live, you could have hundreds of thousands or even $1 million flooding into your checking account all at once. Having an account that is DIF insured could be useful while you figure out what to do with those assets. Likewise, someone who sells a business will have a large cash holding until they're able to properly invest the money. Then there's this couple who keep $1 million in cash because it helps them sleep at night. Do you need a bank account that is DIF insured? No, in most cases. You're not going to need that. In general, most people will want bank accounts with no fees and high yields. I love those. Those two features tend to be a lot more important than accounts with large insurance coverage. However, if you're looking at a liquidity event, selling a home, business, you need a lot of coverage. If you're near Massachusetts, opening a bank account in a DIF insured bank could be a really easy way to protect your new cash cushion. Otherwise, you'll want to open one of the many accounts that offer deposit sharing, which allow for individuals to have up to $2.5 million in FDIC insurance coverage. That's all we have. I know that was a quick one, but I hope it was helpful and informative. Thanks so much for stopping by today to the College Investor Audio Show. If you have any questions at all about money, maybe a depositor's insurance fund, maybe FDIC, maybe where to find the best and highest yield banks, we have it at thecollegeinvestor.com. Thanks again. We'll talk to you again very soon.